On Friday, we received what should have been good news, but I actually think it's bad news. Inflation is falling too fast, and that's a sign of a recession coming on. Gross domestic product is at 3%, and that's holding up there. And these are backward-looking gauges. It doesn't reflect what's happening at the exact moment, and government data has been less than solidly reliable. But this headline read on Friday, which the market did not react very well to, and the NASDAQ even went down considerably. Fed inflation gauge at 2.2% in August, which is lower than expected. The PC price index, a measure the Fed focuses on to measure the cost of goods and services in the U.S. economy, rose 0.1% for the month, putting the 12-month inflation rate at 2.2%. It was expecting it to be at least 0.2%. And when you have only 0.1%, if you annualize that rate, that's an inflation rate of 1.2%, which is well below the Fed's target of 2%. The Fed is behind. They're about 2 percentage points too high, which is dangerous. Excluding food and energy, core PCE rose 0.1% in August and was up 2.7% from a year ago. Again, it's 0.1%. That's 1.2% if you analyze it. The all items inflation gauge was below Wall Street estimates and the lowest price since early 2021. Wall Street did not react well. The stock market did not react well because this is actually bad news. This is confirming that the Fed is behind in lowering interest rates. So the bull market enters the fourth quarter with just about everything going its way. All the economic data is positive except for jobs, which are softening. And I think that's going to be the critical thing coming in the next week. It's all about the jobs data. The rest of the data looks good, including the inflation data. The only problem with the inflation data is it's falling too fast. And the Fed is expected to lower interest rates by another 0.5 point. They're lowering it a 0.5 point at a time for a reason. It's because they're behind. It's because things are probably going to have a somewhat soft landing, but it will be a landing. I think we're at the top of the market. I'm out of the market for now. There are many reasons to have concerns about artificial intelligence stocks right now. Supermicro stock plummets on reported Justice Department probe. The stock, which was up 4% just before the report, tumbled enough to lead the S&P 500's losers on the day and over the past 3 months. There's lots of concern about their record keeping and their accounting. They have wonderful numbers and statistics. The problem is if you can believe those numbers. Supermicro's problems were on Thursday, and then Friday we got news from NVIDIA, which drove it lower. So on Thursday, technology and artificial intelligence stocks got socked by Supermicro computer being investigated. And then on Friday, China urges local companies to stay away from NVIDIA's chips. NVIDIA can only sell slower AI chips to China due to U.S. curbs. Beijing is fostering domestic champions like Huawei and Cambricon. Beijing is stepping up pressure on Chinese companies to buy locally produced artificial intelligence chips instead of NVIDIA products, part of the nation's effort to expand its semiconductor industry and counter U.S. sanctions. Some of the news on artificial intelligence recently has been discouraging. I'm a long-term bull on AI. I believe in it deeply, but I think it's going to take 2 or 3 years for it to really take off. When the dot-com bubble burst, it took like 10 years for that to get going, really going. And I think OpenAI is central to artificial intelligence, and eventually we'll see outstanding results. They're even predicting outstanding results for next year. But right now, I think it's taken a pause. And I think that the market in general is going to take a pause, especially if inflation keeps dropping dramatically, which could signal a recession. OpenAI sees roughly $5 billion lost this year on $3.7 billion in revenue. CNBC has confirmed that OpenAI expects about $5 billion in losses on $3.7 billion in revenue this year. Figures first reported by the New York Times. Revenue is expected to jump to $11.6 billion next year, so that's a massive jump. A source with knowledge of the matter confirmed. But is it really going to hit that, or is that just the AI hype? OpenAI, which is backed by Microsoft, is currently pursuing a funding round that would value the company at more than $150 billion. And it is notable that Apple recently decided not to invest in OpenAI. I think it's going to grow. I think it's going to be outstanding. I think it's going to be a blockbuster. But again, I think we're going to have a pause. And headlines like this are part of what gives me pause about this market. Utilities are a very defensive investment. Utilities are the hottest part of the stock market right now, on track for their best year since 2000. That is not the type of headline I expect to see in a hot market, a truly hot market. The thing that I feel most certain about is that as the interest rate goes down, bonds go up. And that is why I'm buying significant amounts of high-yield corporate bond ETF, symbol HYG. It's gone up 9.21% in the last year, and it pays a dividend yield of 5.8%. So you get the high yield, the 5.8%, plus the bond itself goes up in value as interest rates are lowered, which is bound to continue. My thinking is largely the same for Bloomberg High Yield Bond ETF, JNK, which you can think of as junk bonds. And in the last year, it's gone up for a total return of 8.41%. It pays a dividend yield of 6.42%, and you get the increase on the bond, on the value of the bond, as they cut the interest rates. So I'm putting significant money both into junk and high-grade corporates. These bond funds that I'm investing in are normally risky, but they're significantly less risky in my mind when they are cutting interest rates, which is why I'm doing it. And it seems like an almost for sure thing, which I hesitate to say, but as close as a for sure thing you can have in these uncertain markets, these may be it. The important numbers for next week will be job-related mostly. On Tuesday, we have the JOLTS job openings, which is forecast to come in at 7.64 million, which is a decrease from the previous 7.67 million, which should be a negative. Also on Tuesday, we have the Atlanta GDP, which is forecast to stay at 3.1%. On Thursday, we have the initial jobless claims, which is forecast to come in higher at 221,000, which is more than the previous 218,000, which is a negative. On Friday, that's the really big day because we have non-farm payrolls and we have the unemployment rate. The non-farm payrolls is forecast to increase slightly to 144,000 from the previous 142,000. If non-farm payrolls comes in below 100,000, I believe the market will go down 5%. The unemployment rate is a big deal. If that goes up, the stock market will similarly have a negative reaction. It's forecast to stay the same at 4.2%, which is what it was the previous month. Right now, I'm thinking of day trading UDOW, UDOW, which is the triple leverage fund on the Dow Industrial Average. And the reason I might be switching away from TQQQ, which is the triple leverage ETF on the 100 largest companies on the NASDAQ, is because cyclicals are becoming more important. People are switching to the cyclicals, which in my mind is another sign of it's not a hot market. I don't see how you turn away from technology in a truly hot market. So I will play the UDOW on selected days when I feel certain of it. But that's just kind of a fun sport for me to do in the meantime while I'm waiting for the market to settle down. That's the way I roll. Thank you.